G'day, Rose Jacobs here with you for Kalkinemedia. Today we're looking at how high inflation has taken a strong stance in the world economy. Be sure to press that bell icon first for all the latest updates. As the world economy has entered the recovery phase, the market factors are dwindling rapidly. Due to demand-supply imbalances, high inflation has taken a strong stance in the world economy. Additionally, interest rates and cost of living are mounting high. Amid all the market fluctuations, countries are finding personalised ways to deal with the economic crisis. However, it is difficult to predict how the market will be performing in the coming weeks, as there really are two extremities: the arrival of Christmas and Omicron. The Christmas period is expected to induce more consumer spending and thus good performance in the market. However, the most dangerous variant of the coronavirus has now erupted, and it is yet to be seen if the market would keep performing well or fall in the same pit of recession once again. Nonetheless, until the effect of Omicron isn't clear, let's focus on the stance taken by respective central banks to tackle inflation and related factors. In the US, the job market is undoubtedly running at an all-time high. Additionally, stimulated consumer spending due to Christmas are injecting good money into the market. However, the level of inflation is raging high due to high oil prices and supply chain imbalances and more. As a result, the inflation rate in the US is running at 6.2%, which is the highest in the past 30 years. So to deal with high inflation and subsequent imbalances, the federal government has raised interest rates. However, increasing the interest rate might not be a permanent solution, as it can be counterproductive and send confusing signals in the recovery period. The UK is one of the countries that are highly dependent on world trade. Thus, it has been severely affected, of course, by the rise in oil and gas prices globally. In October, inflation reached 4.2% and is expected to go higher by February. As a result, the inflation rate in the UK is the highest of the decade. Therefore, to combat the market variations and instabilities, the UK is planning to increase interest rates. However, policymakers worry that high interest rates would imply higher living costs, and people would demand higher wages, and so on. So the UK can slip into the loop. The EU has taken a different stance than the US and the UK. The EU is running at an inflation rate of 4.1%, which is a 13-year high. However, the EU is not planning to raise interest rates yet, and the Union controls the interest rates of 19 member nations. The official believes that the purchasing power has been low throughout the pandemic, and it's still squeezed due to high oil and gas prices. So, rising interest rates and therefore the cost of living will place a hurdle in the economic recovery. Australia is staying patient in terms of raising interest rates. Australia is relying on Australian exceptionalism. However, Japan is an exception to the inflation surge, and recently the country announced a spending stimulus package to its citizens. Additionally, it is doubtful the interest rates would go up for China, considering the property sector's fragility. So conclusively, it is interesting to note how different countries deal with market fluctuations in so many unique ways. Central banks of respective countries were making policies unknowing the adverse effects on the new Omicron virus that it could cause. It is yet to be seen how the virus plays out with market variables. But that is a wrap for this video, and if you've enjoyed it, then please feel free to like, share or comment, and you can subscribe and check out more info at kalkinemedia.com. I'm Rose Jacobs. Thanks for joining me.